Welcome to CGM Premium. We have a couple of our clients. They're growing their business. They have questions about different things. So we created this platform to kind of bring in knowledge leaders like yourself to talk about things in their realm. So accounting, legal, lending. We have like bankers that come on and talk about lending. We have accountants that come on and talk about accounting. Marketing professionals and teachers at Temple come on and talk about marketing. So today, the third week of the month is usually dedicated to some type of law or legal concept. And we get a lot of questions, as you know, when people come in, they set up their businesses and they hear things in the streets, hear things on the internet. Hey, what's this? What's that?
Yeah,
My eyes go like, okay, here we go. So I never want to claim that I know things that I don't. I love bringing in guys like you and Jay and a good friend of mine. I think you know Matt, Monroe, some guys that can really talk to it in depth. Rachel Pritzker has been on before. So I
hmm
definitely want to extend a thank you to coming on tonight on such short notice, man. Really appreciate it.
sure, absolutely.
So do you want to give them a little bit about yourself, like how long you've been practicing, tax equity? Do you
Absolutely.
have any
Yeah,
questions?
I've been a lawyer for about 10 years. I started my career at a big global accounting firm doing tax law, really doing mergers and acquisitions of large Fortune 500 companies. And then I spent about 5 years at a national law firm, again, doing a lot of tax and really structuring businesses for growth and working with a lot of closely held businesses as they expanded, took on new money, took on investment, expanded across country, maybe across internationally, and helped address sort of the growing pain business technical issues, including mostly how to get in tax compliance on a lot of different things. Like as you add payroll, as you add employees, as you add property, as you add sales in different jurisdictions, how to move money around intercompany. These are sort of problems that if you set up the structure early on as your business is growing, you can really set yourself up for financial success on the back end. Part of that work turned into advising business owners as they grew their businesses, they got wealthier, they might have sold a business or a portion of their business off, had a lot of cash, didn't know what to do with it. So kind of have a general background in estate planning and financial management as well. And about 3 years ago, I started my own firm, met Dom, and kind of the rest is history.
One of the questions we get a lot, especially the last like 3 months, is like, what's a trust, and can I throw my LLC in it? So I know like we can't go deep into like legal advice,
Right.
but can you talk a little bit about like what a
Sure.
trust is and how it's, I know there's different forms of trust. People got to know
Right.
that too. But what a trust normally is set up for, and then how people can utilize the trust, like you said, for asset transfer.
Right. So in short, in a short explanation, a trust is a way to take assets out of your name and put it into a legal vehicle that's not an LLC, that's not a corporation, but it is a separate legal identity from yourself. And what this does is it allows that asset to go out of your name. The benefit of taking an asset out of your name is it may protect that asset from being reached by your creditors. And or historically, trusts have been used to avoid complicated issues of estate probate and estate tax. The US has had varying levels of estate taxes and tax exclusion amounts. Today, the estate tax exclusion amount is $22 million. So for the most part, most regular people are not forming trusts. But if you have a lot of assets and you have a complicated estate or a complicated set of heirs, you may find that putting some assets into a trust may legally protect it from your creditors or may make your life easier on the administration side after your death. When we talk about trusts, we have two general forms. We have revocable trusts and irrevocable trusts. A revocable trust is a fake trust. It's a trust that for legal purposes is a separate entity, but for tax purposes is not. So that's a trust that you can move assets in and out of freely during your lifetime. But once you die, it kind of becomes cemented and it becomes the trust. That doesn't give you a ton of creditor protection. It doesn't protect you in a bankruptcy, but it does give you a certain amount of anonymity if that's what you're looking for. It makes it potentially harder for a potential creditor to identify what assets you have if they're thinking about suing you. The other form of trust you generally see is a irrevocable trust. This one is set in stone the minute you form it. Once you contribute your assets to it, those assets no longer belong to you. They belong to the trust, and the trustee, the person responsible for caring for the trust, has responsibility and custody over those assets. People on the internet say, let me put my business into a trust. Well, what are you really trying to accomplish?
So
Are
thank
you
you.
so worried about a creditor coming after you and going after all of your assets? I think that the internet does a great job of exaggerating the risks. Okay. If you put your business in an LLC and you don't give a personal guarantee on any debt, then generally courts are not going to look through the LLC. Now, you run into some issues where a court may find that you commingled business and personal assets. So if you don't have a separate bank account for your business, you don't have a separate credit card for your business, you don't have a separate email address for your business, courts may say there was no difference between the business and the person. But if you take some steps like forming an LLC, having a separate business email, having a separate credit card, separate set of books, not mixing personal expenses on your business credit card, you're going to be sufficiently legally protected that your creditors are only going to be able to go after the assets of the business in the LLC, and they won't be able to go after your home. They won't be able to go after your non-business use vehicle, maybe your rental properties that are part of a different business. But a lot of people on the internet read about Wyoming trusts because they give you a lot of anonymity. You don't have to give your name anywhere. I think that this is oversold as an idea. And I think that it just adds like sort of an extra layer of bureaucracy that if you're a startup business, you may not need it. You may not need that kind of level of anonymity. If you're really worried about people coming out of the woodwork and chasing down your wealth, then the Wyoming trust or some other form of trust might be a good way to just sort of hide yourself. Octavia?
Hi, okay. I have two questions. So first, with regards to the irrevocable trust, you said that when you put your assets in in a trust of that type, that they no longer belong to you, they belong to the trust. So in the event that I have a trust and all of my assets are in it, and I get married, something happens to me, would would those assets then would not, if my home is in the trust, my business is in the trust, those assets then would not follow that normal chain where they just pass on to your spouse? There would be some, you know what I'm saying? There would have to be.
Yeah, that's correct. So the trust would set forth who the beneficiaries of the trust are. Probably the trust that you've created sets you as a beneficiary. So while you're living, you get the benefit of those assets. The income that flows to you out of that trust is income that can be subject to forfeiture by one of your creditors or by an ex-spouse, or it's income that's at risk. But the actual underlying assets in the trust would go on to the next beneficiary named after you die. So if you're putting stuff in a trust because you want to keep it out of the hands of a spouse who maybe you got married after you had kids and you're worried about inheritance issues, with your children and you wanted to protect your children, I could see a trust being one method to resolve that. Another, possibly easier and less irrevocable method is a will, because once you form an irrevocable trust, you generally cannot be the trustee and the beneficiary. That would be a defective trust. So you're really putting a lot of faith in the management of the trustee if you're going to be a beneficiary during your lifetime. But if you put it in a will, you can avoid issues of probate, and you can specify to the courts who you want to inherit which specific assets and which general assets of your estate. And the benefit of the will is that you can change it every Tuesday. If you want to change it on a Wednesday, you're free to change it on a Wednesday too. So if you wanted to name your daughter in your will and disinherit your husband, we have some issues in Pennsylvania with a spousal's right to a certain amount of the estate. So we want to be very careful about that.
And one other question. So can you talk about when it may be a good idea, or what the difference is maybe between creating like a holding company to put assets in versus a trust, or when it's a good idea to use?
I think real estate is the kind of asset that always belongs. It's in its own LLC. Each piece of real estate should be specific to its own LLC. You could layer an LLC holding company on top of that. And if you have different lines of business, you could have each business in its own LLC held by a holding company. The benefit of an LLC is you can devise membership interests. You can make gifts of membership interest to your heirs in your will, and you can divide it up however you want. Alternatively, we can use an LLC to avoid probate by giving membership interest to your potential heirs during their lifetime. And those membership interests can have a limited set of rights today. So they might not have value today. They might not share in the profits of the company today. They could basically be dormant membership interests. And as certain events are triggered, those membership interest rights will increase over time. So as you near retirement and your kids start to take over the business, their LLC membership interests, some people call them shares, might get more valuable, might have more voting rights. And this way you can pass off a significant amount of wealth and avoid hitting some of the federal government estate tax limitation number of $22 million. Trusts are also useful tools for that. I think trusts are better for managing already generated wealth. And so if you're a dynastic family that has owned a lot of land and has a lot of wealth, and it's going to exist for multiple generations, it's a good time to have that in a trust, because a trust is much more beneficial for passive ownership, like not active business management ownership. If you put your business in a trust, the trustee gets to make the business decisions, right? So if you are building a business right now, it's better to keep your business assets in an LLC and you be the holder of the LLC.